Many people say, oh, I should have sold at 60. And this happened so many times to me. I sold a stock with winnings and I thought, well, I just buy back later, right? But this didn't happen and I lost a lot of money. If you find a jewel for you and you bought it at 30, why not even like it more and buy more for 15? Now imagine what happens when it goes back to 60. Welcome to another video here on this channel, and we are talking about space. I should have sold at 60, right? This is something that everyone who is invested since the summer of space think to itself. Because if you're opening space, then you see that since then we are quite let's say, it's easy to say we crashed quite a bit, okay? 75.14% was the biggest year-to-date downdraw, okay? This was because we had an all-time high in basically in February where we reached $60, but then in the summer we reached also 50s and I think 55s during the intraday. And many people say, oh, I should have sold, right? This is something that many people are telling themselves. And I think that is a lack of self-discipline. If you are a little bit into reading, I can really recommend you the following kind of book, which is fantastic and gives you a mentality for traders, okay, and investors. And this is, for example, this one. This book is about, I'm currently reading it, this is about some top traders. I think there's like 2 or 3 books out of this same author. And he interviewed the best under the radar traders, okay? They have a better performance than all the S&P 500. They have a better performance than all these big hedge fund managers. They are just having their own thing. Some people are trading, some people doing like social arbitrage where they're seeing things into the overall situation and then trading for themselves. Some people use mathematical models, some people just use more or less their gut, right? So there is a lot of different traders, but there's a lot of, let's say, coming together when it's about self-management. The people are actually mad when they, for example, make more winnings than they make losing. So in other words, to say, if their gains are very volatile, they are not happy with it, okay? They want to have a steady gain over the years instead of, oh, this time I won 1 million and another day I lost $500,000. That's a very, let's say, kind of hard way to see where it's going with your overall account. Very volatile, right? They want to have it like it's steady. So things like space obviously is still very volatile. So for traders it's perfect if they are into, you know, buy and sell. But for us as long-term investors, it's like a long-term hold without looking left and right. And there's 2 very important things that I want to tell in this video today. For once, it's about market timing. Let's have a look what one of the best investors ever said about market timing.
How would you rank the recent market downturn in terms of investing opportunities in stocks during your investment careers?
Well, it's certainly not as dramatic as the 1974 period was. Stocks got much cheaper in 1974 than they are now, but you were also facing a different interest rate scenario, so you could say they really weren't that much cheaper. You could buy very good companies at 4 times earnings or thereabouts with good prospects, but interest rates were far higher then. That was the best period I've ever seen for buying common equities. The country may not have been in as much trouble then as we were back in September. I don't think it was, but stocks were somewhat cheaper then. In the recent period, I bought some equities, and then corporate bonds looked extraordinarily cheap. The spreads were very wide, so I bought some of those too. But the cheaper things get, the better I like buying them. I mean, if I was buying hamburgers at McDonald's, the other day for X, and they reduced the price to 90% of X tomorrow, not likely, but if they did, I'm happy. I don't think about what I paid yesterday for the hamburger. I think I'm going to be buying hamburgers the rest of my life, and the cheaper they get, the better I like it. I'm going to be buying investments the rest of my life, and I would much rather pay half of X than X. And the fact that I paid X yesterday doesn't bother me if I get it, as long as I know the value is in the business. So on a personal basis, I like lower prices. I realize that is not the way all of you feel, and that when you wake up in the morning and look at quotes, but it just makes sense that when things are on sale, that you should be more excited about buying them than otherwise. And lately, when I wrote that article, the Times, I did not predict what stocks were going to do, because I never know what they're going to do. But I do know when you're starting to get a lot for your money, and that's when I believe in buying. Charlie?
Well, if stocks go off 40% on average, they're obviously closer to an attractive price than they were before. And of course, interest rates have gone down a lot recently, at least short-term interest rates. It's nothing like 73.4.
No.
I knew when that happened that was my time and my only time. I knew I was never going to get another trip to the pie counter like that one. Unfortunately, I had practically no money available, which is...
That's why it happens.
That's why those times occur.
Yeah.
So you can see the Oracle of Omaha, Warren Buffett, is saying it all the time. Like, if you find a jewel for you and you see value in the company and you loved it and you bought it at 30, why not even like it more and buy more for 15? There's no reason except your emotions. There's no reason except your ego. And combined with this knowledge that I gathered from all of these traders reading all of, not only that book that I presented, in the first part of the video, but also during the whole last 10 years, I read so many books on trading and psychology and watched YouTube videos on psychology. There's a lot of things that I catch myself onto and say, oh, I don't buy back because now it's a higher price. And this is the biggest risk for people out now who went out of space and saying, oh, I sold at 25, now it went to 50, now I'm great, right? I will wait until it dropped to 10. Then it will go to 20, then it will go to 30. And they're like, I'm not buying for 30, I sold it for 25. So it goes to 40, it will go to 50, it will go to 60, it will go to 70, eventually it will go to 100. And this happened so many times to me. I sold a stock with winnings and I thought, well, I just buy back later, right? But this didn't happen and I lost a lot of money on many, many stocks. Apple, for example, I sold too early. Tesla, I sold too early. So I'm trying to not make the same mistakes over and over. And Charlie Munger, in this snippet that you just saw, says something also very important. He says, oh, I saw this opportunity and I knew that it doesn't come back that early anymore. Okay, so we need to be responsible for our thinking that some situations just don't come back. All right, and with interest rates so low, historically low, even when we do the rate hikes next year, it's so low that money coming into the market and it needs to go into something, and equities and stocks are just the right vehicle here. Maybe even crypto, yes, but crypto will have a next difficult year because the inflation narrative will go to an end, to go to in peace, because there will be a deflationary effect and the inflation will actually, curve down. So this will be quite interesting. However, I believe there's another second part to this video that is very important that I would like to show you guys, because then we're going into some mathematical geniuses about a falling stock and I should have sold at 60. Okay, here is the thing. So let's do a little bit of math. Let's say you sold at 60 and you go away with your winnings. You bought in at 25, or let's say to be easy, at 30, you made your 100% and you go away. All right. Now we are the group that actually bought at, let's say 15, then it went to 60. We should have sold, but now it's back to 15 or even 14. So what I'm doing, I'm just buying more for less, okay? I'm still buying more for less. I'm buying. What happens? Yes, exactly. So I'm seeing a lot of average going down. So my average, let's say, it was before 20 because I was buying on the upper side, and now going back, let's say I have now a $15 average. Let's say both people bought at the same time. The guy who sold at 60 made 100%, and the guy who's holding is now at $30, but he has the price now of $15, so he make a 50% loss, okay? Now he's keep on buying, so his average price will go down and down and down and down and down until it reaches 50. Now imagine what happens when it goes back to 60. Not only he have much more money into the investment, but also what happens is a mathematical beauty, because from 30 to 60, it's 100%. But from 15, 100% is 30. 200% is 45. 300% is 60. So we actually make now on a bigger amount of money 300%. We are just talking when the stock goes where it should be and where it will go, to $60. So I'm really a big fan of that. I did this at Tesla and made so much profit on my investment because I did dollar cost averaging down, okay? It was tremendous. It was unbelievable how the stock then went up. And also remember, guys, there's short squeeze, there's the Phoenix of the ashes effect, where people say, okay, this company will never succeed, but it does and goes up. So there's a lot of things that we can look forward to, and I cannot wait to really see this stock is going absolutely nuts in the next couple of years. The explanation mark is at years with an S, okay? It will take some years until we see the full effect, but that's investing, where you get more 300 or more % in just a couple of years. It's very hard. It's just when you find the right company. So obviously this is never financial advice, and let me know in the comments what you think about this timing the market thing.